About to make you host real quick, Dan. You should get an invitation, my friend. Sorry, I have to record a little bit up front because once I give Dan some control, then I lose recording power. Did you get that yet, Dan? All righty. While Dan is looking for that and getting all that set up, please, all of y'all, as you sit and listen, maybe keep a little piece of paper and jot down a question or two. Something that's curious to you as Dan speaks. And then you can actually ask Dan that question either at the end or you could chat, post something in the chat. But this is meant to be interactive in that sense. Dan, do you have full control now?
I think so. Allow me to see if I could. Okay. I think so. Okay. We got it. Okay. Thank you, Kevin. I appreciate it.
Yeah,
and again,
I don't see anything on your screen if you're sharing, just FYI.
Okay. Let me just try this to see, make sure that it's working. And let's see. All right.
Looks like it's working now. You got it. All right. Okay. You're in charge now, Dan.
Okay, perfect. All right. So wonderful. Well, good morning, everyone. And again, thank you for coming out and supporting me in this scholarship efforts. And again, I have to thank Aspen University and Kevin for providing me and my colleagues the opportunity to share some ideas with you. So having said that, I introduced myself last time for some of you who were here. But again, I'm going to introduce myself briefly to some of the people who are joining us for the first time. I have to tell you that I've been with academia for a long time. This is my 32nd year of teaching for different universities, and relatively I'm new to USU where I teach currently, and also I teach for UCSD Extension. And I had a career in transportation for 20 years. And I was with an international transportation company, and I had different positions in there. I was operations manager, and later on the director, and so forth, so on. However, I entered the academic environment in capacity of being administrator as the director of academic affairs for University of Phoenix. That was 2005. And however, I asked the university to let me go back to my teaching because I love teaching. So that's briefly about me. In education, I do have a Bachelor's of Science in Economics, MBA, and also I'm a PhD candidate. So these are my background. And a couple of things before we get started. First of all, you're my colleagues. And again, I'm going to provide you some opportunities during the speech to reflect on the presentation, and please express your opinion, your expertise in the matter. And I'm going to be basically perhaps twice at least. I'm going to be pausing in my presentation to provide you opportunity to express your opinion or ask question, if you will. And by doing so, basically, you have also opportunity to get involved. Okie doke. So let's get started. Okay, last time I talked about the economic impact of COVID on the United States economy, and that was our first one. This session, I'm going to be talking about global impact of COVID-19. And but before I get on the global side of the discussion, I'm going to be finishing what I couldn't finish last time that we were here in last speech, and that was part of the economic impact of COVID-19 in the United States. there were a couple of things that I didn't get the chance of sharing, and those are kind of important, or at least in my book, to it briefly. So I'm going to go to my first. I'm going to go to my PowerPoint speech one PowerPoint, and then we'll switch to second one. So that's not it. Okay. So allow me to go and pull the PowerPoint. Not this one, sorry. Okay. So let me just enlarge this, make it, okay, full screen. Okay, this was my last PowerPoint as we discussed many aspects of the COVID-19 impact and devastating impact, I should add, on economy of the United States. But and we talked about GDP, we talked about stimulus packages, quantitative easing, unemployment. We briefly talked. Basically, I did not cover unemployment, and we did not cover inflation and national debt. I'm not going to spend majority of today's discussion on these because we already talked about the most important things, but I'm going to finish this, if you will. Therefore, I'm going to be spending a few minutes to wrap this one up before we get start on the second one. And again, these are the things that we shared. Okay, so unemployment, basically, the reason I still want to talk about unemployment, although I did not cover it fully last time, is that it's important economic indicators. One of the, basically, every economic downfall, every recession starts with unemployment. Unemployment is cause for all the troubles, as you can imagine, and you're basically witnessing these days that the issue with our economy is just people are not working. Simple as that. And why some people are not working? Of course, when people are not working, there is no income, and there is no, therefore, since income is not there, taxation is not there, revenues of the government is declining, and corporations suffer because there is less demand for goods and services. Therefore, they cannot pay their taxes. So you see that every ugly things that you could imagine happens when unemployment happens. So times like this, obviously, we talked about it last time, government spends a lot of money to stimulate the economy, to get the economy out of trouble. And that creates, of course, an annual budget deficit, and also adds to our national debt. We briefly, I'm going to touch on it today as well. However, unemployment rate of 39.3% in hospitality industry was the highest in our history. Just imagine that. That you we know how significant hospitality industry is for specifically some of the states, like state of Florida, California, many other states. And imagine that 39.3% unemployment in that particular industry basically is devastating. That's obviously the biggest in our history. National unemployment was 14.7% in period of April 2020. 14.7 is devastating, folks. Again, this is an average for all the industries, but for instance, let me just give you a magnitude of this one, how important this is. In financial crises of 2007 and 2008, when our economy was in trouble and the whole nation was upside down, we had unemployment rate of 10%. And it was devastating. Now this is 14.7%. Although it is not right now 14.6%. This was from April of 2020. Right now it's around a little bit over 6%, which much better, of course. Okay, let's move on. Okay, so again, the importance of unemployment. Since March of 2020, 10 million people lost their jobs, folks. 10 million people. That's twice as population of a country of Denmark. So, so this is a lot of people that we got unemployed, and the biggest was, of course, travel and hospitality industry. I talked about it. Retailers try to adapt the new business model, and what is it? As we all know, basically trying to market their product online, social media, and many deliveries are being made well, people do not visit the retail stores. Normally they deliver to you. I mean, you could see many companies like DoorDash and Amazon, and many companies are basically doing that. And this is a new way of doing business. This is a new business model for all these companies, folks. I hope you understand the long-lasting and long-term impact of COVID-19 in our economy. Basically, it is going to be changing the business model of all the companies, not only in the United States, all over the world. This is significant. We're gonna be doing business in totally different way. We're gonna be running our lives in different ways. So, small businesses trying to survive, as we know. Independent contractors were impacted severely. So also the low-income service workers were also among the ones that impacted severely. So that's briefly about unemployment. And again, I'm just kind of trying to save time here, manage my time, just because we have a totally different presentation after this. But I'm just, okay, I think I said what I needed on the unemployment to just give you how critical that indicator is. As I talked about it last week, again, I'm going to reiterate the ramifications of what we're doing these days as far as saving the economy. We all know that in order to save the economy, policymakers, specifically federal government, has to spend a lot of money that they don't have. And what do I mean by money that they don't have is that, as I briefly touched on it earlier, when economies in trouble, when we have economic downfall, the level of the government income and revenues declines. Okay, so here the revenues are declined, but on the other hand, government has to spend a lot of money to save the economy. So there's a big discrepancy here, and that's the dilemma. Therefore, the only way out, naturally, debt, borrow money. And of course, we talked about this again briefly last time. Quantitative easing is the avenues by which government basically issues treasury bonds and also mortgage-backed securities. And again, what is mortgage-backed security? I'm going to talk about this in our third speech when we talk about the impact of COVID on financial markets. It's basically, this comes from the financial crises. Federal government had to purchase a lot of toxic notes, toxic mortgages from banks. And what the government does, the government basically sell these to Federal Reserve and get cash. And then basically just Federal Reserve, what the Federal Reserve does, put these in their balance sheet, and then provide funds needed for the government to save the economy and spend on different programs. So here again, of course, when they do that, when the federal government does spend money that they don't have, meaning that borrowed money they're spending, that creates the budget deficit, as we all know, and adds to our national debt. And again, I talked about this national debt last time because, again, I'm not going to repeat everything, but our national debt has grown to $27 trillion. much more than our GDP. Again, I talked about all this. I'm not going to spend time on it. All right, the last one, inflation, again from the last week. Inflation basically is another economic indicator that we need to pay attention in time of crises like this. Obviously, here the issue is not having high inflation. In times like this, that economy is in recessionary mode or period, high inflation is not concerned, but rather low inflation is concerned, which has sometimes become deflation. Deflation actually is more dangerous than inflation. And the reason being is that deflation is a sign of ailing economy, meaning that economy is not active. Economy is dying, essentially. Inflation in sustainable level is a good indicative of a good economy, believe it or not. Meaning that economy, when we have a kind of sustainable level or lower level of inflation, we say, hey, look, everything is hunky-dory, everything is looking good. Why? Because people do have money to spend, therefore their demand and for goods and services increases, therefore increases the overall price on all the goods and services. That's inflation. So it means that people do have money to spend and they are increasing their demand for everything. Therefore, the price of everything is going up. Of course, there's only one reason. Inflation causes could be myriads of reasons, but this is the most important one. That's why I wanted to share with you. So what happens here is that when we see that we have a deflation, meaning that decrease in the level of inflation and even going to the negative side, then it's very concerning, meaning that economy is totally sick, totally ailing. So here, if you look at this particular table, you see that our inflation rate to 2019 was 2.3%, which is wonderful. That's the inflation that we it's a sign of good things. All of a sudden, 2020 becomes 0.8%, less than 1%. I'm sorry, less than less than 10%, and that is 0.8% basically. So that is bad sign. That is basically the economy is not doing very well. People don't have money to spend, as we all know this. However, the prediction is that inflation rate is going to be increasing to 1.6% in 2021. And we've already seen the signs of it. And by 2022, it may hit 1.7%, which basically is acceptable inflation rate if we could sustain it. In the meantime, federal funds rate, again, I'm going to talk about this a little bit more in detail next presentation when I'm going to be talking about financial markets, what is federal funds rate and why it plays an important role in our economy. But again, in this particular table, you see that the federal funds rate dropped from 1.75% to 0.25%, meaning that 1/4 of 1%, that is 0.25%. It is basically is close to zero, meaning that we had 3 times in our history that we dropped the rate to less than 1%. Great Depression, Great Recession or financial crisis after 2007, 2008, and impact of pandemic right now. Okay. Again, these are some charts. I'm not going to spend some time on it. Briefly, again, annual inflation rate is calculated by CPI, and that's Consumer Price Index. That's the comparison of the basket of goods from one year to another year. And let's suppose that we spend, I don't know, $1 million in purchasing all kinds of stuff in 1 year, and then buying the same stuff the following year, exact the same stuff the following year, and comparing to the price. So if we spend $1 million in 2020 and we end up spending, I don't know, $1,100,000 buying the same items in 2022. So what is the percentage of inflation rate? 10%. So that's how we calculate the CPI. It's just letting you know how we come up with the inflation rate. Okay, I talked about. One more thing that before I go to the next presentation is hyperinflation. Hyperinflation is a heart attack, if you will, kind of comparing and again, I'm going to talk about more about this next speech. That if you imagine money is like blood in your body, money in the economy is like blood in your body. What blood does to heart and how we make it heart attack is exactly the same way with the economy and money and hyperinflation. Hyperinflation could be translated as heart attack for the nation. So that's one of the reasons that we try to avoid high level of inflation. However, like I said, inflation in a moderate level, sustainable level is a good sign, but we don't want it to go either direction drastically, become hyperinflation that gives us heart attack, or goes to deflation that basically we starve to death, if you will. Housing market, I talked about it, and again, I'm not going to be spending time on it. I was brief enough, but I think we already got the idea. So I'm going to just skip these. Okay, recovery, again, I briefly talked about it last week, but this is another chart. You see the impact of vaccination in of course, people's lives, therefore the economy. And you see the charts are basically showing two types of a cycle. One is V-shaped, the other one a U-shape. V-shape is normally when the economy gets in trouble, is like falling in a ditch and coming up again drastically. That gives us the V-shape cycle, which we experienced on 2020, as you can see in this chart. And of course, U-shape is the cycle that is normal. Like if we don't have any crises, our economy normally grows in cycles, and you know that. Economic growth is about expansion, peak, recession, trough, again expansion, again peak, again recession. So that's basically a roller coaster ride, if you will, of economic growth. I'm going to talk about it in more detail next time we meet. But here you see that basically the impact of the vaccine in our GDP, and how our GDP is going to be increasing, how economy is going to grow the moment we administer the vaccination of the nation. And of course, the prediction is by 2022, our economy should be growing 3% steadily. That is, again, a good sign. This I added this because last time I had a question about the impact of the pandemic on consumer behavior. And again, I'm going to be brief here. Obviously, what people do when we have a situation like that, we have crises like that. People cut spending, obviously, and however, the spending again rebounded because of many reasons. Number one, of course, was the stimulus package in giving people money and making them enabled to again start spending. unemployment benefits, PPP loans, and many other stimulus means were basically contributed for rebounding of consumer spending. Okay, that's it, I guess. Okay, and again, what's the takeaway? I already shared that with you. Is that we still the future is really is in blur. It is not very much crystal to see why, because there are a lot of questions that we haven't come up with the answer with, and a lot of variables that are not really forecastable at this moment. But we know for a few things that many businesses are not going to be surviving this pandemic. We know that even the companies or businesses that are going to be surviving, they're going to have a different business model. And also, of course, the things are not going to be the same ever. Okay, that's it. So we're going to go to a second slide, which is about the topic of global impact of COVID. And again, I want to check that everybody's here. Okay.
Yeah, you got a good crowd today, Dan. You have probably about 25 to 28 people in there.
Wonderful.
We're all excited to see what's going to happen to the world now.
Okay. All right. All right, here we go. Global economic impact. Again, here, I would like to just let you know what I did. Okay, what I did was I briefly talked about or analyzed and did some research on global economic impact of COVID, picked some indicators that are very much important in all the nations. And in the meantime, also, I selected certain countries and plus EU. Obviously, EU is not under the countries, but of course, that's another region that I to talk about these economies. And bear in mind here, if we really want to discuss the economy of, let's say, China, Mexico, Canada, Japan, or EU, we need another 4 hours. Okay, of course. But what I did was I basically picked few numbers on each from each country, numbers of indicators, measures of economic activities, in compare those with what we have here in the United States. Basically, that the benefit of this is that, hey, how other countries are coping with this in comparing to how we're coping with it. Are we doing better than other countries? Are they doing better than us? And which country is in still more trouble than the other one, and so far, so on. So it's going to be very brief on each country, but I'm going to put a little bit more emphasis on China. Now, first question is that why in the world I picked only these countries and EU? Because of their relevant relationship with us, with the United States. China is now world power. Mexico and Canada, just because we have a close relationship as far as the trade or as the economic activities, for instance, NAFTA in the past and so forth, so on. And Japan, because again, we have close relationship with Japan as far as the trade with the Japanese, and of course EU with obvious reasons. Okay, this is something that I had last presentation, and purpose of it that I'm displaying again in this presentation is to show you when we talk about economy, when we talk about the measures of economy and how we're going to understand it, the economy is doing good, bad, whatever. these are the most important measures or indicators. If you look at it, consumer behavior, national debt, U.S. Fed balance sheet, and GDP, inflation, and all these good stuff. So again, I'm displaying that to just show you that all these indicators had very bad signs. Basically, many of them that shouldn't be declined, and many of them that should not be increased and increased. So, for instance, GDP decline, inflation decline, and so forth, so on. Okay. First of all, again, before I go forward, anybody wants to ask question or say something about this or express your expertise opinion on this one, then again, I appreciate and welcome your comments. Anybody? Okay.
Dan, I don't have a question necessarily so far, but I am curious, and I know you're about to jump into this part of your presentation, and that is when we're talking about this sort of economic crisis that we're in, and you go through these countries, which of the countries have it right? That's my question to you, is which of these are actually maybe doing it the way that we might want to be doing it in the future so we can replicate their recovery? That's all. That'd be my question as you get to that country.
Excellent. Good question, Kevin. I would say, first of all, the way that we handled it and comparing to other countries, we really don't want to follow other countries' measures. But if we want to see who had the less damage and who had the situation or managed their situation with less effort, was China. Okay. Now, is this the model that we want to follow? Perhaps not. Why? Because our systems are different. Our infrastructure of the economy is different. Therefore, it's not a model for us. But if you want to compare to among all the countries who had less trouble, less issue, less of resources spent in fixing the economy, was China. With the minimum effort, their economy came back, and it's in the right, currently is in path of recovery. In comparing to other nations, actually, we're doing much better than almost everybody else, believe it or not. So Europe is very much behind. And the reason for Europe's demise is the second wave of the COVID that basically prolonged their recovery process and also delayed many of the policies that they had for recovery purpose. Therefore, they are behind. They still are having a lot of issues, a lot of problems, and so forth, so on. When we compare ourselves to Japan, we're in better shape. Canada, we're in better shape. Just a little bit, maybe Canada is kind of similar to us. But answering your question, Kevin, is that China had the least effort in fixing their economy, and they are back, and they are ahead of everybody. But is that the model we want to follow? Not necessarily. Did I answer your question, Kevin?
Yeah, and you're exactly right. I mean, obviously, you know, it's apples and oranges sometimes. The only thing about China is if we're saying that they actually did it right, we're basing it on whatever they tell us is their data. And the question is, can you trust what they tell us? You know, they obviously want the rest of the world to look like everything's fine. So they will then, you know, spread that word, and that will be the story. Now, whether that's true or not is the bigger question. But it sounds like they had least amount of damage. But part of it is because of their infrastructure, their government, they can impose upon everybody without question whatever their rules are. In other countries, you have a little more choice in how you want to participate in that process. So we value freedom, I guess, over other things, you know, that they are able to use to their advantage in this unique scenario where it was actually a benefit to maybe be more government controlled. When it comes to a pandemic. So anyway, that was my only question, Dan. Thank you.
Yeah, you're welcome. Actually, majority of the industries in China is controlled by the government. So that makes a big difference, as you mentioned, Kevin. Thank you. Okay, Chinese economy, Chinese has overtaken the United States as a world power. Now, bear in mind, this doesn't mean that they are economically better than we are, because still we're number one as well as the GDP and many other economic measures. However, this statement, the sentence says that they have taken over the world economy as powerhouse. It means that they have more basically export to other countries, and they have a more import and export and trade relationship with the rest of the world more than the United States of America. So basically, they have taken over the world as a powerhouse as far as exporting their stuff to other countries. Why this is significant? Because we were the one historically that we played that role. We were the manufacturing king of the world. We had many of the services that we exported to different countries, still we're doing. But China took us on this one. If you look at here, they account for 16.5% of all the exports versus ours is 6.3%. Part of this is also goes back to our balance of trade, which basically we are running deficit in balance of trade for last God knows how many years. I mean, at least as far as I remember, like 30 years. Why? Because, again, it's a lengthy discussion, but just briefly, because we normally buy other countries' products if they are made better than ours. Basically, we're the greatest market for all the goods and services, just because we're wealthy, because we can afford, but because also we want to have variety of stuff. So that is the reason that our imports supersedes our exports. And it doesn't mean this is bad. It could be bad for other countries, meaning that if Greece has more imports than exports, that's bad, but not for us. We're exception. Imagine that we have a mansion in a neighborhood that many of the other houses are like ghettos or very, very cheap houses. So our grocery bill normally is higher than the others. That's the reason. Okay, so a couple of measures here. Chinese economy output in 2014. And why I have 2014? Because I have a graph for it. I'm going to show it to you. It reached its $10.38 trillion compared to the United States at the same period for 17.5 trillion. So this is significant because of this. If you look at this, folks, economy of China was not like this. When we had the GDP of 11 trillion, their GDP was just about 2 trillion. And so meaning that they have made a lot of economic growth throughout these years. And we're talking about from the day that they opened their gates to market economy, and when they entered as a player in international markets, they have made a great stride. If you want to track back to see how long this has been, I would say from the day that Ronald Reagan basically opened the relationship with Chinese. From that day, they start growing like crazy. So still they have the most or highest economic growth in the world. So if you look at this GDP of China in 2019 was 14.3%, for 34%. And again, if you remember in previous slide, it was 10.38 in 2014. After 5 years, it became 14, and ours also grew to 21.43. In 2020, China's GDP increased to 15.5, compared to ours is 22.2. So what's the takeaway again? So first of all, let's describe, and I'm going to tell you why I showed you some of those figures in just a second. But just to understand Chinese economy, Chinese economy has been described as a socialism with Chinese characteristics. This is kind of a new definition. We didn't, never had this before. We had either socialist countries or capitalist countries. Now we have socialism with Chinese characteristics. Obviously, we know China is mixed socialist market economy, meaning that they're basically they're a socialist country, but they open their doors to market economy, so they're mixed. So as Kevin said, here is actually a bullet point about it. As of the end of the 2019, the total asset of all Chinese were Chinese owned enterprise, Chinese state-owned enterprise, I should say, meaning that what the government owned was $63.8 trillion worth. So as you can imagine, government-owned enterprises in China is $63.8 trillion. So it means that almost government controls everything. Government owns many of these enterprises. So that goes to reiterate what Kevin said, that is that infrastructure is different than ours. 91 of the state-owned enterprises belong to 2020 Fortune 500 companies. So 90 of the Fortune 500 companies are Chinese, believe it or not.
Dan, I just want to give you a time marker here as a heads up. We have about 15 minutes before the hour, and then you can have another 10 or 15 minutes or so for any questions if you need that. But just to give you a pacing marker right now, you're doing a good job. Yeah.
Thank you. Okay. Again, here is many of the Chinese growth and economy, and specifically success in their economy, is about it's because of the foreign direct investment, FDIs. FDIs basically is the main drive of the economic growth in countries where they need foreign investments. The success of Japanese economy, success of Chinese, Korea, Singapore, and all these countries are because of the FDIs, and that plays an important role. Okay, I'm going to just, since I have limited time, I'm going to just be very brief on some of these. And here is another graph, shows us the Chinese post the weakest economic growth since 1990 into 2020. Year 2020, when pandemic hit, they had the weakest growth since 1990, as this particular chart shows. This is another chart that shows how deep their economy went in trouble late in 2019. And we're talking about the real retail sales is one measure here. The other one, fixed asset investment, value added industry. These are all declined drastically, as you can see here, even the point of minus 25%. So let's move on. Now, what is the status? The status currently is the coronavirus remained largely under control in China. As I mentioned earlier, there has not been any COVID deaths since mid-April. Amount of 374 patients were hospitalized as of November 15, and you see that that's not many. That is down from 58,000 on February of 17. So from February that they have 58,000 people hospitalized to November, that declined to 374. And that comparing to the United States, in the same period of time, we had 69,864 when they had 58 people hospitalized. So coronavirus basically is largely under control in China. People have been able to resume to largely, and again, let me see, okay. Normal life. All of these Okay, as I said earlier, all of this with only modest physical and monetary stimulus. They really didn't do as much as we have done so far for our economy. Um, with the least effort, the economy is back. This is, I don't know, again, I have limited time, folks, but this is something that I'm going to be brief to let you know that in previous administration, we had, of course, a kind of uh, not very encourageable relationship with Chinese because of the restrictions that we put on their imported items. Uh, that basically is changing because of the byproduct of having restrictions of importations, basically restricting the free trade in the world, always has a negative impact, except for certain exception, situation like protecting our own industry and so forth, so on. But the point I'm making here is that if you see this, um, the byproduct of our restriction with Chinese in previous administration was lower investment opportunities, disturbing the supply chain, creating the retaliatory tariffs and restrictions from the other side, and reducing the manufacturing employment. So those were all the byproduct of the previous administration's policy in dealing with China in trade relationship. What we need to do in new administration, these are again kind of relevant stuff. China's U.S.-Chinese relations to develop over 3 phases under the Biden administration should be changing the language and rhetoric, because we don't want to call those people, enemies and bad people and all these things. Changing the rhetoric is important. Opportunity to develop a trade strategy and also developing a long-term stable relationship. So those are basically are the focus of the Biden administration, and hopefully will be successful in accomplishing all those. Mexico was another example that I picked for this presentation just because of their close proximity to our economy in our relationship, trade relationship with Mexico. Just again, briefly, if you look at it, the country is they are the 4th largest auto exporters in the world, behind Japan, Korea. Okay, the auto industry, of course, is the biggest industry, and they employ every 6 Mexican factory workers are working in the auto industry. Again, FDI's foreign direct investments plays an important role in Mexico's economy, and which basically accounts for $40 billion annually. So what is the impact of COVID on Mexico? It basically their economy shrunk to minus 8.5% in 2020, the largest single year drop since 1932. Again, see how significant this was for Mexico. Since 1932, they haven't seen such a thing. Mexico's gross domestic product grew 3.1% in 3 months of the year, meaning that recently currently they are in that level, in that rate. Contraction of 18.7% compared to the same period of prior year, 2019. Okay, here. What is the takeaway? Mexico's government did little to support businesses or subsidize consumers. They basically didn't do anything. So again, comparing to our own nation, these are again some GDP figures of Mexico. Okay, Canada, and I hope, folks, I'm sure that you understand. I am so brief here, and just because, unfortunately, I don't have much time to elaborate in all these economies and go a little bit in depth. But just to give you some ideas that how other countries are dealing with this pandemic. Okay, so in Canada, COVID-19 pandemic second wave. Okay, again, Canada had also experienced the second wave. Their economy contracted with 5.4% in 2020. It was worse than the United States. Canada's economy will grow by 3.5% in 2021. That's the prediction. And that's going to be a little bit better than the growth that we're going to experience in 2021. And again, this is a segue to this discussion, is that I'm going to talk about this on my last speech, number 4, when we talk about the what are we going to be expecting in the future, and what are the forecasts for all these stuff, and especially economic indicators. I'm going to talk about what are we going to experience in 2021, 2022, and going forward. But for now, just letting you know that in 2021, the predictions or the forecasts are we're going to be growing our economy in a faster pace than it was in previous years prior to pandemic, let's say 2019, 2018, which was 1.75, 1.55 respectively. But we're going to have that growth to be almost doubled in 2021, which is this year. So we're going to have 3.2% growth, GDP growth. Canadians are going to have 3.5, a little bit better than ours. Okay, so deficit. Again, in order to manage this situation, the Canadian economy had to borrow money like we did, meaning that government had to borrow money, created the deficit of 381.6 billion. And guess what? This is the largest deficit in their history. So again, reflects what the pandemic is doing to the world, folks. And you see all these historical records are being broken in all these different countries because of pandemic. We never had severity, economic downfall, and severity of the impact of anything than COVID-19 that is doing not only to our economy, but the economy of the world, as you can see in some of these very brief measures and indicators that I'm displaying here. Unemployment rate that declines, and it would be declines from 13.7 to 8.5 in 2020. Okay, let's move on. Yeah, okay, Japan. Japanese economy shrunk 28% during the outbreak of pandemic. Japanese economy is likely to remain in a severe situation for time being. So we're coming up, we're coming back. We already started the path to recovery, but you see some of the countries are still in trouble, including Japan. So again, their economy is likely to improve, mainly because of the improvement in the demand and effective macroeconomic measures. Basically, the Japanese government was very active, as much as ours, in dealing with pandemic and trying to stimulate the economy as much as we did. Their stimulus package was 110 trillion yen, equivalent of like, just about $1 trillion of our, meaning that it is 110 trillion yen kind of is equal to 1 trillion. So they spend just about 1 trillion in their economy. Of course, if you compare that to ours, is a totally different picture. We already spend over 6.2 trillion, including the 1.9 trillion of President Biden's. So you could see the differences here. Okay, I'm not going to talk about the exchange trade funds and all these stuff because there are going to be a lot of detail on it. I'll talk about this in my speech of financial markets next time. So still there are a lot of significant uncertainties over the pandemic and impact of COVID-19 in Japan. Bank of Japan would closely monitor the impact of COVID-19 and would do whatever it takes. In about 2 minutes, I'm going to finish this, and hopefully, pardon me, folks. I mean, there are a lot of stuff here, and I have to be brief because we have limited times here. So, EU capital are still negotiating which project will get funding from 750 billion euros, which again, that equates to, and it's equivalent of like $1 trillion, our money. So that's their package for rescuing the economy. And delays of the of course, EU vaccine rollout makes it harder for European countries to go back to path of the recovery, and they are behind the 8 ball. As like I said earlier, they are not as advanced in the vaccination. Therefore, the economy still is suffering more than ours. Okay, and again, anything important here? Okay, some packages already approved in EU nations, which is the amount is going to be just about 3.6 trillion at the end of their few packages that they're going to be offering to market, which is 90% of our GDP, 3.6 trillion. It's going to take roughly 9 quarters for the EU to return to pre-pandemic levels, 9 quarters, versus 6 quarters, which is for us. So about 1.5 years, we should be out of it. For them, it's going to be just about 2.5 years. Okay, what's the takeaway? What's the outlook? The second round effect of COVID-19 may raise havoc and push down the economy considerably if countries fail to do 2 things. Number 1, ensure corporate financing and maintain financial system stability by supporting the financial institutions. Folks, this is so important. If we sustain and maintain our financial system and stability of our financial system, nothing is difficult. Nothing is going to kill us. If financial institutions of any country goes down, the whole nation will go down. So that's the takeaway, and the insurance the companies, their shareholders, and also the confidence of the shareholders, household, and businesses is sustained. And if we sustain the confidence in people and businesses and shareholders, meaning that financial markets, so far, so on, that's another reason to come out of this. So in closure, we briefly examined the global impact of COVID-19, and we also analyzed some of the economic indicators of certain countries. And also, bottom line is expeditious vaccination may open the path for faster recovery. Basically, that's the maybe the only takeaway from this particular presentation is that economy is not going to come back fast enough unless we distribute the vaccine and administer the vaccine and vaccination of majority of the people, not only in our country, but all around the world. I think I did it.
Good job. Good, man. By the way, for all the viewers, we've been in this situation, right? We've been where we're talking and presenting, and we just get really excited and go into detail, and then we sometimes have less time to talk about other things. And that's okay, Dan. I don't want you to feel in any way bad. That's normal. You're talking about a very big topic that you're trying to break into 4 little pieces. And the pieces that you pick that should be broken into sometimes bleed over and are part of other pieces. So when you go to your third, anything that you feel is important, you know, that you wanted to include from today, you can include in the other. And it's not in any way a bad reflection. We've all been in that situation. It happens a lot with me. I never have enough time to say everything I want to say. So great job on that. Very, very much bigger picture now. I can see how you were describing the different countries and how you've described in the last presentation our own country, and then I'm able to sort of look at the differences and see, you know, what's similar and what's not similar. But I think we should probably open this now up to anybody who has any questions. If you want to open your mic, that's fine with me. There's about 20 people. Not everybody should do that together. Maybe type in the chat box you have a question or raise your hand. And then Dan can go into the chat, Dan, I believe, and unmute people. And you can let them talk. I'm trying to,
Okay.
is that Glenn maybe, or somebody who was raising their hand there? I can't see the names.
Okay, just let me go to chat, please.
Junior, says Junior there. So.
Uh,
JR maybe.
okay.
It looks like his mic is open, actually. You can go on and talk if you want.
Yeah, if the mic is open, just go ahead, please.
Yeah, Dan, hi. I wanted to ask how realistic you felt that 5% GDP growth for the United States is. I'm shocked at how all the media and all saying the future looks so rosy, given the political change just 2 months ago and all the ambitious plans, all the political confrontation that's still going on. I don't see it personally at all. So I'm wondering if you have any insight. Did you really think we're going to see 5% growth in the current climate?
Good question, John. By the way, good to see you, John. And I appreciate that you're supporting us. Okay, perfect. Actually, John, the way that forecasts are being done, of course, through the statistical measures in some of the variables that they consider, so forth, so on. But bottom line, to be honest with you, is reflecting the past trends in the future. Most of the forecasts are in that manner, okay? So how it was in the past, what we should be expecting in future, basically. So in the past, what we have seen after the biggest demises, after the biggest downfalls, we normally experience the biggest expansion, the boom that happened in Great Depression, that happened in many recession periods, including the 1980s, and it happened in financial crisis of 2007. So that's the natural cycle, okay? Is it going to happen again? We think so. We think so, because all the measures indicated in that way. Now, like you said, John, is it something that definitely is going to happen? Nobody knows that. Are there many other variables that we're ignoring or we're not putting the importance on it or emphasizing on it? Definitely, definitely. Kim, how are you? Rachel, I'm sorry. How are you? It's good to see you, Rachel. These are all my colleagues from my university.
I just want to jump in. So I was listening to Jerome Powell today. He was in the Senate meeting in Congress, and he was telling that the reason why economy might be a little bit prospective in 2020 is that we have highest savings for individual account. So spending might be boosting. So that is how they calculate it. And also interest rate will be under 2%. So I think they count all those factors in when they did the estimate. Just my hopeful comment on next session. So are you going to tell us about which market is the most prosperous for job market or investment opportunity? What is your plan? So give us a little bit peep.
Okay, well,
every show has a preview.
This is the great moment that I need to pitch my own presentation by telling you that's the topic for my next speech.
Mm-hmm.
Financial markets, impact of COVID-19 in financial markets, which is going to be, my God, is like maybe twice or three times as much as substance of the two presentations that so far I had, because for financial markets, my God, you know, we could talk about it for entire year and not run out of the subject.
Mm-hmm.
Having said that, yeah, definitely, interest rates are going to be kept under 1% till 2022. And it may continue on even beyond that, unless they see other signs of, let's say, inflationary fear or inflation push that they may reconsider their plan. But for now, they're not going to touch the interest rates, meaning that not increasing it until 2022. Just to set something in regard to what your comments. But most of the things that I'm going to be talking about, financial markets, interest rates, and federal funds rate, so forth, so on, is going to be next speech number 3.
Great.
Anything else, folks?
Dan, I do think that you touched on a point that is a critical factor that we didn't have as part of our context, through 2020 in particular, and that is that there are, some medical treatments through vaccinations that are out there, whether people believe in them or not. Enough people probably believe in them that enough people will get it, and then we'll have herd immunity. And then, even those who didn't get it, they're protected. People aren't getting sick, and things just kind of go back to normal over time. But, the vaccine, I believe, is one of those game changers. Otherwise, it's just waiting around and trying to change interest rates and sending people stimulus checks and all these sort of passive, things, as opposed to just tackling the virus with a vaccine. And that may be part of the economic solution. And you touched on this during your first presentation. You said every other economic tragedy that we've ever had was caused by something in the economy. And this is the only thing that had nothing to do with the economy. And therefore, economic strategies don't necessarily work when the cause is not economic. So the vaccine may be part of that variable to help with that.
Thank you, Kevin, for that comment. That is so on point, just because, like you said, and also I talked about it last time, is that if there was an economic reason for this downfall, we kind of knew how to approach it. Because, hey, we already gained the knowledge throughout the history, how to deal with this, how to deal with this financial crisis, how to deal with the recession and depression, all these stuff. So we have a model, if you will, strategy to deal with all these. But this, we have no clue. We don't know what to do with it. Like you said, this is not economic reason. This is not about the economy. This is the health issue that shuts down our economy. And this is very important for us to understand, that we never, ever shut down our economy in our history, ever.
Yeah, that was the catastrophic thing that made the difference between those previous ones, like you mentioned. I do have a question, Dan, now that we're kind of talking about some previous, I know we got a couple minutes left. And that is, about how long did the Great Depression last? It was like, what, 3 years or something like that, maybe? And so COVID in a year. And so, over the same time period, was it of equal damage if you recalculate the money, the depression, or COVID? And maybe we don't know COVID enough because it's really not over with. This thing could still go on for another year, and the economic damage go on. So that was my only question. If all things are equal, which was really more catastrophic, the Great Depression or COVID?
Thank you, Kevin. Let me just tell you one thing, and then I'll tell you which one is more catastrophic. In Great Depressions, the danger in the negative impact was because the economic depression or the recession prolonged itself to depression. And what was the consequences of this was that the banks and financial system crippled. Why? If any of you, I'm sure that many of you familiar with this history of our Great Depression, is that when people heard the rumors that, hey, all the companies are closing the doors, banks are closing the doors too. Guess what? Hey, no. I got my money in the bank. I cannot survive without it. So everybody rushed to banks to get their money. And obviously we could imagine that banks didn't have readily available all those money to fulfill the needs. So banks said, hey, I don't have your money. 90%, 80%, 85% of your money is normally invested. I don't have it in my wallet. So banks closed the doors. that was the most dangerous moment in our history. Here, in this particular scenario, we haven't gone that far, okay? However, severity of the economic severity, this is more severe. Why it's more severe? Because first of all, like I said, in Great Depression, only certain industries closed the door, and finally banks closed the doors. Here, we close the doors on everything almost for a short period, of course, and still they are closed in many cases. We never close our schools. So severity is severity is more in this case. But the hope is with the vaccination, because you know what? If the problem was economic problem, it would have taken a long time to come out of this. But since it's not economic reason, vaccination is going to fix it. Am I making sense? Meaning that vaccination.
Yeah, that's actually a good flip side to the problem, because you're saying if it was actually economic based, it would take longer through the economic methods to recover. But because it's not economic based, and sometimes it can recover faster.
Absolutely.
You can fix that one thing that doesn't take as long, right? So absolutely. I don't want to take up any more people's time. I just want to summarize what you said there, Dan.
Thank you.
We invite all of y'all to come back again in 2 more weeks and get part 3. I'll continue to advertise and market and send out to people. Please continue to market and advertise and publish this to your friends and peers. These things are technically open to anybody in the academic community on the planet Earth, right? Anybody who goes at Zoom can actually get in there. We advertise it within, so most of the people within are going to be the ones that show up. But if you have colleagues and friends and so forth that you want to, share that with and say, please show up and participate or look at the things that are happening, you're free to do that and help get, some activity and audience available. We had, like I said, about 25 to 28 people probably in and out throughout the day. People have to come and go. Otherwise, we'll see you on a couple of weeks, and I'll send everything around of this video recording and a summary. Take care. We'll see you soon. Bye, everybody.
Thank you, folks. Take care.
Bye.
Bye.
Bye, Jaya.
Bye. Take care, Rachel.
Thank you.
Thank you.